Look at a dollar bill. Now look at a stick you found in the woods. Physically, they're both just pieces of nature we picked up. One isn't inherently more valuable than the other. Society collectively agrees the paper has purchasing power, and the stick doesn't. We've built an entire system around this shared belief. The government prints the currency, central banks regulate its supply, and you trade labor for it. But while the money itself is technically an illusion, the mechanisms controlling it are very real. If you don't understand the rules dictating who keeps this currency and who loses it, you're actively losing. Before a single paycheck hits your account, the extraction begins. The state automatically takes a portion of your wages through federal and state income tax. Then comes Social Security and Medicare. The government mandates that you surrender part of your current earnings, effectively forcing you to save that money for health insurance and payouts you'll receive in old age. Think of this as the required cost of civilization. It funds local schools, paves roads, and builds the billion-dollar missiles deployed overseas. After taxes, you deposit the rest in a bank. We imagine that money resting safely inside a fortified room, guarded like a dragon's hoard. This diagram shows how banks actually operate on fractional reserve banking. They act as matchmakers. The moment you deposit $1,000, the bank keeps a tiny fraction on hand and instantly lends up to $900 of it to someone else. This system relies on the assumption that depositors won't ask for cash at the exact same time. When everyone shows up, like in 2008, the structure crumbles. The second you earn a dollar, the system begins moving it. Money left idle in a bank is completely exposed to the broader economy and forces outside your control. Inflation is a slow, invisible erosion of purchasing power, silently reducing what a single dollar can buy over time. This visualization shows what happens when people have too much cash, but supply chains lack enough product. 2,000 people trying to buy 1,000 TVs means the business knows it can charge more. The price tag spikes. To stop this spiral, the central bank intervenes by raising interest rates. They make getting a loan more expensive, which strips cash out of consumers' hands and forces the economy to stop spending. That cooling process triggers recessions. Growth shrinks for at least 6 months straight. Corporations slash their costs, and jobs disappear as the economic cycle forces a painful reset. Your money is trapped in a constant tug-of-war between inflation eroding its value and recessions threatening your ability to earn more of it. Navigating this environment comes down to trust. Lenders use an algorithm called a credit score to decide how much risk you pose when borrowing money. This chart shows exactly how that 3-digit score is built. While factors like credit age matter, it heavily prioritizes payment history. Paying your bills on time is the ultimate proof of adult credibility. That score determines your interest rate. Interest is the rent your money charges to exist in someone else's hands. When borrowing, you pay for holding their cash. Simple interest charges a flat fee, but compound interest means dollars clone themselves, charging rent of their own. Interest acts as the ultimate pivot point for your remaining capital. When you owe it, it accelerates the drain on your income. When you earn it, it works as a tireless, unpaid employee. Investing is the primary defense against systemic erosion. You stop trading limited time for a paycheck and start trading your cash for assets that work on your behalf. You can buy stocks, which are tiny ownership slices of a corporation. You can buy bonds, effectively loaning your money to the government. Or you can buy real estate, hoping someone else pays to live there. The engine driving all these assets upward is perceived value. Just as humans collectively agreed to value shiny gold over a normal gray rock, markets reward those who create things society wants. Apple built a device that millions of people decided was immensely valuable. That massive perception of value translated directly into thousands of dollars per customer, funneling wealth back to the creators. While fixed wages often lag behind rising costs, those who control perceived value can adjust their prices to outpace inflation. Escaping the drain requires shifting from trading hours for a paycheck to owning a stake in that value creation. To make that ownership actually count, you need the most strictly limited asset on Earth: time. Wages scale linearly, just trading your hours for dollars, but investments given decades to grow scale aggressively and exponentially. The vast majority of wealthy people didn't hit a lottery jackpot. They simply deployed their capital into the market and gave compound growth decades to do the heavy lifting. The economy operates on invisible forces designed to extract your wealth, but by learning the rules of investing and leveraging time, you can rig the game back in your favor.